for joining in. It's been a tough few days in the market. I mean, despite the sort of up move that we've seen at the index level, individual stocks, they've been all over the place. How do you navigate yourself through a market like this?
So thank you for having me on your show. But we've been calling this out for a while now that we always felt that the market will trade in a band. In fact, at the beginning of the year, we thought that the market will be first half will be a total flattish kind of a market. But now with the data points coming out of the US, I believe this flattishness may just extend for the year as such, and maybe it'll be a very narrow band in the market trades. But I don't think there's enough for us to panic. But the fact is that the globe is not going to, the global markets rather are not going to be stable for a while, and that is what is probably playing on our investment sentiments. I mean, look at the data points coming out of the US, right? The unemployment data, the low figures that came out of unemployment were last seen in 1969 in the US. After that, you saw a runaway inflation kind of a period for the US. And secondly, I mean, the fact that the Fed is now talking about a higher rate, which is obvious, because if you see these kind of numbers, you have to pull up the rates and shock the market. So that's why you're talking about now 6.25 when people were talking about on 5.25 as the peak rate of interest rates from the US Fed. But I think that all will play upon everybody, and I think we are better placed because our internal consumption and the fact that the manufacturing is kicking in also to that extent for outsourcing. I think that will prop up our markets to an extent, and maybe we won't see as much correction, but it'll be a flattish kind of a market for the year.
In that context, the Friday, February jobs data, the non-farm payroll data is going to be very crucial. The next FOMC meeting, remember, is on the 21st and 22nd of March. And from now to the next FOMC meeting on Friday, we'll get the February jobs data. And remember, this comes on the back of a very strong January jobs data. And the last FOMC meet had not reacted to the January jobs data. The January jobs data had come after the last FOMC meet. So this FOMC meet is going to take into account two jobs data, January and February. And then on 14th of March, we've got the US CPI inflation number. And if both these turn out to be red hot, it will greenlight the Fed into perhaps accelerating on the rate hike cycle. So that's going to be the big anxiety, worry point, and a talking point for the markets until we get that decision ultimately. Dinshaw, morning, and thanks so much for joining in. So if now we need to position ourselves for 12 months or 9 months at least of very flat, lackluster moves, from a portfolio point of view, what are the big changes? Because earlier you were positioning for a pickup in the second half. Now that's not going to happen. So what are the changes that you would recommend? Should we up the cash that we hold in our books?
Actually, it's afternoon. You said no morning. So let me just correct you.
Afternoon.
But anyway, so basically what we've decided was that we actually were looking at external facing sectors. We thought that probably things will pan out to an extent, and probably we get a good opportunity to pick up some exporters like IT services and stuff like that. But that doesn't seem to be the case. I think it's better to stay away from them. And actually, you're seeing that of late now. I think some semblance is coming in valuations in the IT space at least, but still it's fairly far away from what our comfort levels are. So we'll still wait it out. However, what we did rather add to was basically the domestic facing plays as such. Consumption was one such theme. We're looking at manufacturing as another theme that we're adding to in some way or the other. And obviously our favorites is the financial sector. And that also now, instead of NBFCs, we've got very limited exposure to those now because our belief is that with interest rates moving up, and they have to move up in India, though we don't have an inflation issue, but our interest rates have to keep pace with the US just to manage the currency as such. And as a result, you will see some kind of pressure on the asset side for these NBFCs. So that's why we're staying away from those. In fact, in our long short portfolio, we're short a few names there as such. Probably the only NBFC that we have an exposure to is mainly the one which deals with CV financing and so on. Yeah. So that's one. And obviously the banking sector is where we are focused on. And that again, the private sector banks. The argument that went against the private sector banks was that the NIMs have probably peaked out, and from here on, one may see a compression in NIMs. Maybe so in the short run, but in the longer run, I think the offtake will be far greater for the lending book, and obviously that will compensate for the mild compression that one may see in the NIMs.
Dinshaw, hi, good afternoon. Surabhi here. So I'm going to ask you about something interesting. Let me confirm this first. I believe you've added some of these high-profile new age stocks recently to your portfolio. I don't know if the names are right, but I got to know somewhere that perhaps you've been looking at Paytm and even a Zomato. Do tell us if that's the case, and if so, what's the rationale? Because despite the talk and a lot of promise of profitability, early break-even targets, the fact is, in terms of the share price, that needle isn't really moving much from the lows.
So, okay, Surabhi, I won't confirm or deny the names. The fact is that the fintech company that we picked up, platform company rather, that company has done fairly well. Okay, today you should just show this graph. It's not doing too well today, but from the time we picked up, it's done fairly well. And frankly, I mean, we did add to it a bit. In fact, after the quarterly numbers, our comfort levels, in fact, moved up quite sharply in that name also. So that's why we added to our existing portion as such. And frankly, the call here is even in the food tech space, both these platform offerers, what do you look for in a platform offering? I mean, basically that there is convenience, that convenience can be encashed, and is it appealing to the masses? And is it replicable easily? Well, the answer to the last question is a definite no. You've seen that in the case of food tech companies. In fact, globally also, if you look at the various other markets, developed markets, there are only two players, and the number one player is a faraway leader as compared to the number two player. In India, fortunately, there are only two players who are equally divided roughly. In the case of fintech, I remember a time a couple of years ago when every third company or every two of three companies were fintech companies which were coming out with IPOs. But fortunately, that has tapered off. Quite a few have melted away. In fact, some have folded up. So you can see this one single big guy really gaining going forward as such. And the market has never been an issue. The potential to mine this market has never been an issue. So obviously, these two are the ones which will gain over a longer period of time, and that's why we remain with them.
Well, Dinshaw, from new age companies, let's also talk about some old economy stocks which you liked. And this one is from the Adani group. I mean, I remember, you're being extremely bullish on both their ports business as well as their cement assets, and also entered at the lower levels. Have you made enough profit, or do you continue to hold on to them for a bit now?
No. We will continue. We were not looking for any opportunistic play here. We will continue to hold on. The fact is that look at the data of the ports. I mean, 40% share of container traffic, 25% share of port traffic. It's a huge company, and frankly, I mean, you can very well justify it on cash flows, on PEs, on EV/EBITDAs, or whatever you want to play it out with. So that's one. And Ambuja, frankly, has been a pure play cement company, and just came into the group fold 6-7 months back as such. Otherwise, it was a fairly standalone good company. But the group has brought in a lot of new, if you will, I mean, cost-saving measures in terms of, say, energy costs or in terms of transport costs. I think that will add to the earnings growth for this particular stock also going forward. So that's why we continue to hold on to these names.
Okay, so that's some of the Adani group entities. Just a follow-up to that, I guess government capex is the one constant theme in this market, right? That's why the money has been consistently coming in from the government, and then also in terms of market participants. Are you looking at playing that at all, Dinshaw? If so, how?
So basically, Surabhi, we have been looking at names, and unfortunately, we don't like those names who are directly doing work for state governments or for central governments, because as you know, that there's lots of payment issues, there are lots of dealings which don't appeal to us because we look at ESG as a guide for us. But frankly, I mean, we're looking at certain private players who are not directly dealing with government expenditures and stuff like that. So we're still trying to find a footing there. So I won't even try to disclose any names out here.
Right. Just to follow up, Dinshaw, on your Adani investments, I mean, you have publicly spoken about Adani Ports as well as Ambuja, but after the decline that we've seen, does any other Adani Group stock also fly into your radar?
Not really, because I mean, actually valuations are, so basically our initial call also was very clear that viability is not a problem, it was a valuation issue, right? And still after these huge corrections, our analysts still can't justify the valuations as such in some other names. So we're staying away from those. And frankly, I mean, these are long drawn, projects which are going to reap benefits after 4 or 5 years. So might as well wait for 4 or 5 years and then look at those names again at that point in time rather than try to get into them now.
Dinshaw, great conversation. We'll have to leave it there. Thank you very much for joining in. Need to slip into a short break. On the other side, we'll tell you what dealing rooms are saying in our segment D Street Chatter. We'll get you a few technical BTST ideas from our experts too.